Hello and welcome to Moneylife News and Views. I'm Debashis Basu. From the market bottom of 15,183 or so in mid-June 2022, the benchmark index, which is Nifty, has soared about 69% to hit 25,791. That was last week. In the 18 months alone, Nifty has surged 52%. All investor segments, individual investors, mutual funds, other domestic institutional investors seem to have made good money from this bull market, except, of course, reckless derivatives traders. And this lot has lost about 52,000 crore in FY24 alone, according to a study by Securities and Exchange Board of India. What about foreign institutional investors? Surely with their superior knowledge, long years of experience, and deep research and large funds at their disposal, they should have reaped the largest benefits from this bull market. Well, here are some shocking overall numbers about the investment trends. Between June 2022 bottom and 20th September 24, that's last week, FIIs were massive net sellers during a bull market. Yes, you heard that right. They recorded net sales of about 1.82 lakh crores, the biggest monthly sales coming exactly in June 22, at the exact bottom of a short, depressed period between November 21 and June 22. Even at those low valuation, panic sales by FIIs of over 58,000 crore in that month remains unsurpassed. They pressed huge sales at the bottom of the market. Indian and global markets were under pressure at that time. That's from almost late 2021 due to a variety of factors. High valuation, sharp rise in US inflation, weak post-COVID recovery in China, and of course, Russian invasion of Ukraine, which pushed up all commodity prices and shipping freight costs and so on. Now, who did the FIIs sell to in those dark days of June 22? Well, to domestic institutional investors who were huge buyers of almost 47,000 crore that month at, as I said, what turned out to be at the market bottom. Surprisingly, this trend was repeated with boring regularity thereafter. Take for instance, January 23, when Hindenburg revelations about Adani's stocks shook the market. The mini crash was an opportunity for the domestic institutional investors to buy, and they bought over 33,000 crore that month, while panicky FIIs sold shares worth over 41,000 crore. Of course, even savvy investors sometimes get it wrong, but FIIs collectively took surprisingly poor calls at almost all major market turns. Now, here I must say that all my numbers are fundamentally based on the daily cash sales that are reported. Some of these numbers are subsequently changed, or SEBI has a different set of numbers from what is initially reported, and so my figures may be slightly different from what you read elsewhere. Now, to go back to what I was saying, while FIIs did invest strongly between May and July 23, the earliest stage of the current ongoing bull market, they quickly turned bearish over the next 3 months, pressing net sales of 76,000 crore, which were, as I said, with boring regularity lapped up by the DIIs, that is, domestic institutional investors. Their net purchases those 3 months when FIIs were selling in mid-23 was 70,000 crore. And so when the market took off in mid-November, it was the DIIs who gained handsomely, with FIIs looking rather foolish. Undeterred by this experience, FIIs remained net sellers every month between January and May 24, barring March, when they had net, and that to a very timid net purchase of just about 3,300 crore. What happened in the pre-election months? Well, they sold shares worth 1.26 lakh crore, while DIIs made net purchases of over 2 lakh crore. The FIIs were overcautious. The DIIs were probably reckless and were buying. We don't know. Well, that call went wrong again for FIIs. The market fell on the day of the general election results and continued to march higher. Surprisingly, even in the first 4 months after the election, FIIs only made a small amount of net purchases and pressed over 20,000 crore of sales in August. However, there have been net buyers so far in September. Now, all these figures may be influenced in a small way by large bulk deals where one side of the transaction is not an FII or DII. The trend is very clear. Over the last 29 months of a strong bull market, domestic institutional investors were big buyers and foreign institutional investors were probably net sellers. We don't know what the actual final figures are, but they are probably net sellers. How times change. At one time, the dominance of FIIs in the Indian market was so complete that the late R. Ravi Mohan, who was then the managing director of CRISIL, had said the reverence for FIIs had now metamorphosed into mixed feelings of fear and awe. What is surprising, though, is not that the FIIs got it wrong. Professional investors do get it wrong often. Their image of being cool, competent professionals who remain calm during market euphoria and wait to buy at a fair value after deep research and exhaustive diligence is often false. But their mistakes are almost always acts of commission, not usually acts of omission. How does that work? In a strong bull market, they chase the flavor of the day and act like retail investors. In 1994, they had loaded up on global issues of asset-heavy, poorly governed Indian companies. In the bull market of 1999, they frantically charged into shady software companies, either based on imitation or rumors or joint positions with speculators, another fund, or in expectation of a price run-up before overseas equity offerings. The flight to irrationality, exactly what we saw in 93-95, led them to create exposure of almost 60 to 80% in technology, media, and telecom companies at huge valuations. What happened next? In the crazy bull market of 2005-08, they were overcommitted to another set of hot flavor of the month ideas, which is real estate and infrastructure companies earning very poor returns on capital. But now, for the first time, FIIs have made mistakes of omission, not commission. They failed to participate in the big run-up in better quality infrastructure companies, defense and energy transition, and public sector companies, many of which have reported vastly improved performances. I have no idea why this has happened. After all, professional investing is a competitive business and performance is benchmarked every month. Consequently, even institutional investors cannot remain immune to buying what is working or what is popularly known as momentum investing. For the first time in 30 years, I notice FIIs choosing to swim against a rising tide, and that too for a very long period, 29 months now. The question is, now that the US Federal Reserve has started cutting rates and Indian government's growth-oriented policies seem to be continuing, will the FIIs now start making mistakes of commission? That is, charge forcefully into a strong bull market. Well, we'll wait and see what happens. Thanks for watching, and if you did like it, please share and do subscribe. Thank you.